History of Japanese candlestick analysis. One of the first people known to have used candlestick to predict future price movement was a Japanese rice trader, Munehisa Homa. The Japanese candlestick was later introduced to the Western world by Steve Nissen. Steve researched, studied, lived, breathed, ate candlesticks, and began to write about it. Slowly, this secret technique grew in popularity in the 90s. Without Steve Nissen, candlestick charts might have remained a buried secret, to make a long story short. Just like a bar chart, a daily candlestick shows the market's open, high, low, and close price for the day. The candlestick has a wide part which is called the real body. Traders can alter these colors in their trading platforms. For example, a bearish candlestick is often shaded red instead of black, and a bullish candlestick is often shaded green instead of white. Benefits of using candlesticks. Candlestick charts are one of the most widely used tools by technical traders to analyze the chart. Most traders prefer to use a candlestick chart because, number one, it can help to determine the current state of the market at a glance. By looking at the color and length of a candlestick, traders can instantly determine if the market is gaining more momentum or losing momentum. Number two, traders can easily see the direction of the market. Number three, candlestick charts display specific bullish and bearish reversal patterns that cannot be seen on other charts. Understanding candlestick structure. Just like a bar chart, a daily candlestick shows the market's open, high, low, and close price for the day. The candlestick has a wide part which is called the real body. When the real body is red, it means the session's closing price was lower than the opening price. If the real body is green, it means the session's closing price was higher than the opening price. The thin lines above and below the real body are called the shadows, representing the session's price extremes. The shadow above the real body is called the upper shadow. The peak of the upper shadow is the highest level the price had reached during that session. The shadow under the real body is known as the lower shadow. The bottom of the lower shadow is the lowest price of the session. If the candlestick has no upper shadow, it's said to have a shaved head. A missing lower shadow, on the other hand, is called a shaved bottom. If a candlestick has a short body positioned in the middle, that means a struggle between the bulls and the bears. Such a pattern is known as a spinning top. Sometimes a trader can stumble upon a candlestick where the real body is so short and it's almost impossible to see. It means that the price returned to its initial level throughout the session, and such a candlestick is called a doji candlestick. The doji candlestick or doji star is characterized by its cross shape. This happens when a candlestick opens and closes at the same level, leaving a small or non-existent body, while exhibiting upper and lower wicks of equal length. Generally, the doji represents indecision in the market. Neither the bulls nor bears are in control. Characteristics of a doji star. Number one, it has a cross shape. Number two, same opening and closing price. Number three, small equal length upper and lower wick. How to trade with the doji star pattern. Here is the chart of pounds against the US dollar. The doji star is appearing at the bottom of an existing downtrend. This suggests that neither buyers nor sellers are in control and that the trend could possibly reverse. At this point, it is crucial to note that traders always look for support signals that the trend may reverse before executing a trade. The chart below makes use of the RSI indicator as the supporting signal. Here, the RSI shows that the market is currently in overbought, and a possible reversal might occur soon. During a downtrend, the next candle needs to close above the upper shadow of a long-legged doji, the gravestone doji, and the dragonfly doji. A gravestone doji is a bearish reversal candlestick pattern formed when the open, low, and closing prices are all near each other with a long upper shadow. Most of the time, the pattern always appears after an uptrend. Also, it can be encountered after a downtrend as well. In either case, it signals a potential reversal. The gravestone doji pattern starts after the price goes up sharply after a trading session opens. Then, trouble begins for those who have opened a long position, and prices begin to drop and closes at the session minimum. The longer the shadow, the stronger the bearish potential of the doji. The opposite of a gravestone doji is a dragonfly doji. A dragonfly doji is a type of candlestick pattern that can signal a potential reversal in price to the downside or upside, depending on past price action. Most of the time, the pattern always appears after an uptrend. Also, it can be encountered after a downtrend as well. In either case, it signals a potential reversal. Both the gravestone doji and the dragonfly doji require volume and the next candle for a reversal confirmation.